Hello, everyone. Thank you for tuning in for our portfolio analysis for Miss Wilma Wildcat. Our team is Team 5, and it is Brianne Quatlander, Ryan McNeil, and Ryan Robinson. So the first thing our team is looking to do is to assess our client's financial situation. Wilma Wildcat is 46 years old. She makes $1 million annually. She's a senior executive for a education company. She resides in New York City and she is looking to retire in about 10 years. Currently, she does have a mix of her portfolio assets in different stocks and bonds, and we're today considering expanding that portfolio to also include real estate investments.
Hi everyone, my name's Ryan. I'm going to start with the goal of our analysis. And that was basically the big question was like, how can we increase the efficiency of Wilma Wildcat's portfolio? But we also wanted to reduce risk, the portfolio risk, especially as she's nearing retirement. So like our main goal was to improve diversification of her portfolio. And we did that by evaluating the role of real estate, particularly through REITs. We also used the efficient frontier analysis in order to kind of like optimize our allocation, and then we determined which investment account would be the best for Wilma Wildcat. So here's a breakdown of what her current portfolio looks like. As you can see, she's invested in various market funds, stocks, spread across her retirement accounts as well. Currently, it sits at roughly 77% of total stocks, and then roughly 22% of her portfolio is bonds. She has about 3.17 million currently in assets. Okay, so first we examined Wilma's portfolio using a two-asset efficient frontier, which gives us this data that helps us identify the portfolios that provide the highest expected return for a given level of risk. And as you can see from the analysis, we can confirm that Wilma's current allocation performs reasonably well, but there may be some opportunities to reduce validity without sacrificing long-term growth, especially as she's nearing retirement. So the target returns we have highlighted here are we're targeting 10.5% to 11%, but also that gives us a risk level of 14.1 and 15.3, which may be too high considering Wilma's nearer to retirement age, and she's probably wanting to take on a little bit less risk. So this chart is a visual representation of the data that was on the previous slide. As you can see, as expected returns go up, so does your expected risk. And so when we were analyzing her portfolio, we really had to find like a risk level that we felt comfortable with, but also gave us the expected return that we were looking for her portfolio. So we took a look at the historical return data. We pulled 50 years of data from 1971 to 2024, and the numbers are pretty compelling. All the REITs averaged 10.92% return, and had a standard deviation of 17.7. However, the equity REITs returned even better, 12.76 on average, with a standard deviation of 17.2. And that historical outperformance is what we're really looking to capture with Wilma's portfolio.
In order to consider which specific REITs might be good investment opportunities for Wilma Wildcat, there's some factors that we wanted to consider. So the first thing we looked at was the property sector for each specific REIT that we were examining. And we wanted to look for REITs that were low allocation of office properties because there's a little too much volatility when it comes to return to work, and we're still feeling effects from the pandemic. Furthermore, we looked at geography, preferring REITs that were concentrated with properties in the southern portion of the U.S. rather than the north, because that's where there's more job growth and population growth, according to BREIT. We also looked at net asset value, trying to find REITs that had overall higher net asset value. For example, the JP Morgan REIT only owns 9 properties. So there's potential volatility if some of those properties were to not exactly generate as much NOI as we're used to. And finally, we looked at historical annual returns for different REITs to see which ones could be more compelling. One REIT that stuck out to us specifically was BREIT, which is Blackstone's real estate investment trust. There was good geographic diversity, representation all over the United States, but also a slight amount internationally. But there was concentration in the South and the West of the USA. 22% of Blackstone's BREIT was invested in data centers, which we know is a booming market for real estate, especially with the AI boom right now, as well as 22% in industry and 19% in multifamily housing, with only 3% invested in office real estate. They've had strong returns since their inception in 2017, which you can see listed on the right. However, one downside was there's a high expense ratio, which started at 1.25% and had the ability to see certain increases based on shares and different classes of BREIT stock.
Understanding that Wilma's current mix of investments has an expected return of 10.7% and the expected risk is 14.6%, we need to find the ideal mix to improve returns and minimize risk for our client. As Wilma nears retirement, her appetite for risk reasonably declines. So first we'll consider investments into real estate investment trust accounts, or REITs. So on average, these accounts have historically shown returns of 10.9%. In order for Wilma to maximize returns and minimize her risk when including these REITs, an ideal mix is 11.7% real estate, 63.2% invested in bonds, and 25.1% invested in stocks. However, this mix of assets has an expected return of only 7.5%, which is lower than what she is currently earning on her investment mix. As we can see on this efficiency frontier, the 11.7% investment in real estate is the point where returns outweigh the risk. Next, we considered equity REITs. These investments differ from traditional REITs as their returns are primarily driven from the ownership and operation of physical real estate properties like office buildings, apartments, malls, and on average, these accounts return about 12.8% annually. So for Wilma and her asset optimization, we want an ideal mix of 34% real estate investments, 47% bonds, and 19% invested in stocks. This mix of assets has an expected return of about 9%, which is lower than her current portfolio, but it does have an improved risk posture.
While the over 12% returns that we calculated through NAREIT on equity REITs seem very attractive, we also felt like this might be too optimistic looking into the future, and we wanted to paint a more realistic picture for our client. So one thing we did is we pulled monthly returns from BREIT, and we ended up calculating an annualized 9.8% return from BREIT, which we felt was a little more realistic looking into the future. And here we were able to make an efficient frontier data table. We were able to calculate a similar return to what Wilma is getting now at 10.5%, but you see the expected risk level drops to 8.8%. And we ended up deciding to use this table going forward for our portfolio recommendation because we thought it was a more realistic picture of what we could expect to see in the future. When we move from 2-asset optimization to 3-asset optimization, what we really see is the benefits of portfolio diversification. The data demonstrates that adding real estate makes our portfolio more efficient. So for example, we could achieve the same expected portfolio return while decreasing overall expected portfolio risk by adding equity REITs. And the reason for this is because the correlation between each asset class is less than 1. Since these assets aren't perfectly positively correlated, then combining different assets allows for risk level to drop while maintaining the same level of return. After taking a look at all our options, our final portfolio composition recommendation for Wilma Wildcat is investing in 73% BREIT, 27% stocks, and 0% bonds. This projects to earn a 10.5% annual return with an 8.8 expected risk. And we think Wilma could use this allocation of assets for several years as she approaches her retirement, at which point she can start to scale down her level of risk and move into an asset allocation where risk is diminished, which we've given an example of below, where the target return would be 8.5%. And finally, it's important that we discuss where Wilma should invest her real estate assets. Wilma has 3 different types of accounts: the taxable brokerage account, the IRA, and the Roth IRA. Now, overall, we recommend using the IRA because her $1 million income is too high for Roth contributions. However, she could shift her roughly $35,000 in her Roth IRA right now into BREIT, and this is because REIT income is taxed as normal income and not capital gains. And since her income is so high, she would face a heavy tax burden. However, putting it in a Roth IRA could negate those taxes, or at least remove those taxes from consideration, and putting it in a regular IRA could defer those taxes into retirement. So overall, we think the tax-deferred IRA is the most effective option. Thank you for watching our presentation, and we look forward to fielding your questions in the discussion forum.